Hey, welcome back, options traders. Well, I got another request from one of our traders asking about the Jade Lizard strategy. And I know there's a lot of really weird sounding names out there with some of these option strategies, but this one is exceptionally unusual. It's not one that you hear of a lot, and I believe that it was developed by, for all of you who trade through Tasty Trade, I believe it was kind of started in that group. And the reason is I remember they used to market the some type of a super trader named Liz the super trader, and it was, I believe, the Liz in Lizard is where they got that name. And so remember, the main thing is just because it might have a cool sounding name doesn't mean it has all the rewards for no risk. All strategies are simply calls and puts long and short, but there can certainly be times for using any given strategy because they're simply tools to capitalize on apparent mispricings. But for this video, I wanted to at least show you what the setup is behind the Jade Lizard and some reasons for using it. So what is the Jade Lizard strategy? Let's go find out. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So like all strategies, there's a bull and a bear version. Let's start off with the bullish Jade Lizard. What you're going to do is to start with a short call spread. So if you are long a call spread, it's bullish. If you are short a call spread, it would be bearish. So that seems kind of weird. Why would we be short a call spread if we are bullish? Well, you'll find out here in a moment. Because there's another part to the strategy, you are going to short a put at the lowest strike. Remember that the call spread will have two strikes, one long and one short, and whichever those two are, you're going to sell a put underneath it. Now, one of the basic ideas of the Jade Lizard is that the credit from the put, the short put, should be greater than or equal to the difference in strikes in the spread. Doesn't have to be, but that's really one of the ideas behind it. And if you do that, it's going to reduce that upside risk. So for example, let's say that you sell the 100-105 call spread. And if you did that, you might choose to sell the $95 put for $5 or more. And again, because we have a $5 difference in strikes, if you get $5 or more, it keeps the upside from ever having losses. So again, you can use this as bullish, bearish, neutral, or any shade in between. But most of the time, the Jade Lizard is going to be kind of a neutral to slightly bullish strategy. So here's what the risk graph would look like. So in this example, we were short the 100 call and long the 105, and that gave us a bear spread right there. But then when we sell the 95 put, it gives us this unlimited downside risk. Now again, remember that we sold this put for exactly 5 in this example, so notice how this line right there lines up at exactly 0. That's what I meant on the previous slide, that it keeps you from having no loss. So because we received $5 for the sale of the put, and we have $5 difference in the strikes in the spread, we have no loss at this end of the graph. So we've got a fairly wide range in here for profits. And in fact, if we initiated this position with the stock here in the center, let's say at 97.5, we've got a 7.5% move to either side to get to these break-even points. Now remember, to the upside, if it continues higher, there's really no fear. There's no additional losses beyond here. The biggest risk is obviously here. You've got this unlimited downside. So again, depending on where the stock is, let's say if it were at 87 down here, somewhere between 85 and 90, it would be slightly bullish. You're going to be riding these long deltas up, and then you're going to start to flatten off. So you wouldn't do that if you thought the stock was going to go to the moon. If you put it on with the stock down here at 80, it would have an even bigger bullish bias. You could also start it here with the stock in the center, let's say at 97.5, in which case it's a neutral strategy. It would no longer be bullish. You wouldn't want to see it rise because then you're heading into reduce profits and potentially right up to breaking even. So for the most part, I think this strategy would be set up with the stock somewhere below the strike of this short put. So let's call it maybe in the low 90s, somewhere in here, possibly even 90. But we want to ride these positive deltas up, and then we're going to hit this area of maximum gain. So again, it's still considered to have a bullish bias, even though we could structure it to be neutral. And the reason for that is that if you look at the far left side of the graph and compare it to the far right side over here, there is a bias to the upside. If you had to pick a side for that stock to move, you'd rather see it move this way to the right rather than this way to the left. So that's what it means to have a bullish bias. That doesn't mean that you want it to continue going up and up and up. It just means that that's the side that the strategy is leaning towards. But once again, depending on where the stock is when you initiate the trade, it could actually be a neutral outlook. Now, if you happen to get less than $5 credit for the sale of that put, in this example, remember we have $5 difference in this vertical spread. If you get less than $5, what's going to happen is that risk graph is going to shift down to where you have potential losses at the far right side. So the reason that this happens is that you received less than, again in this example, $5. If we had a $10 difference in our vertical spread, you would want to get $10 for that put. And that's what keeps that black line sitting right at 0. If you happen to sell that put for more than 5, then you're going to get something like this. You're going to get that right side shifted above 0. Like all strategies, once you understand the bullish version, the bearish version is real easy. It's just going to be the same idea in the opposite direction. So what is the bearish Jade Lizard? Well, you're just going to reverse everything that you did before. So instead of selling a call spread, you are now going to short a put spread. And then you're going to short a call at the highest strike. So no matter what those two strikes are that you use in the short put spread, you're going to use an even higher strike for the sale of a call. Remember, that's going to be a naked call. And just as with the bullish version, the credit from the call should be at least as large as the difference in strikes. So for example, maybe we sell the 90-95 put spread, which would be bullish, and then we're going to sell the $100 call, again for, let's say, $5 or more. And by receiving $5 or more, it keeps the downside from ever having losses. So the risk graph for this strategy right here, selling the 90-95 put spread and then selling the 100 call for 5, will look like this. So you can see that to the left side, if the stock does really come unraveled and fall, that we don't have any losses. We just break even. But we always have this unlimited upside. We can't forget that. You have a naked call out here. So that's really all the Jade Lizard is. It's just the sale of a vertical spread with an attached naked option to it. So the main thing to get from this is that you don't want to use this strategy just because you're getting 2 credits. Remember that short options have negative expected values. Yes, you get positive theta, but it doesn't come for free. You've also got negative gamma and negative vega. So rather than using the Jade Lizard just because you think it's some fancy strategy that has all the rewards without any risk, that is not true. Again, remember that all strategies are nothing but calls and puts, long and short. Instead, use the Jade Lizard because of favorable skews or volatility. But those are discussions for future videos. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. You can find it all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.